Andrew Stotz of Stotz Investment Research, talking about top 9 valuation mistakes and how to avoid them. This video is on mistake number 7, valuing a stock using the calculated beta. So let's review the top 9 valuation mistakes that I've seen in the valuation masterclass and also in my career of 2 decades as an analyst. Number 1, overly optimistic revenue forecast. Number 2, underestimating expenses causing unrealistic profit. Number 3, growing fixed assets slower than you grow revenue. Number 4, confusing growth capex with maintenance capex. Number 5, forecasting drastic changes in the cash conversion cycle. Number 6, underestimating working capital investment. Number 7, valuing a stock using the calculated beta. Number 8, choosing an unreasonable cost of equity. And number 9, not properly fading return on invested capital. Let's talk about number 7, valuing a stock using the calculated beta. This is the most interesting subject. What is beta? Well, we can calculate the expected return of a stock, what we expect based upon a few different things. This is a simplified capital asset pricing model, and we can see. First, we start with risk-free rate. Well, we should earn that. Then we could add on the market premium. So if I'm going to invest in the stock market, risk-free rate's 4%, the stock market's 10%, I'm going to get a 6% market premium. So now the next question is, how much are we leveraging up that 6%? That's dependent upon the riskiness of that stock, which is measured by beta. So those beta comes in to adjust that market premium. So it helps us understand if a stock is more, a beta of greater than 1, or less volatile, beta of less than 1 than the market. Movement relative to the market is risk that cannot be removed through diversification. So a government bond, as an example, may have a beta of 0. It doesn't have any relationship with the stock market. Very few stocks have consistent negative betas. There are negative beta stocks, but it's hard to find, and usually there's weird things going on. It's rare that you'd ever find a consistently negative beta stock. But if you could, wow, that'd be fantastic, because you could buy, let's say, a bank, and a bank does well when the market is going up. So beta is positively correlated with the market, and maybe even 2 times the market beta when things are really good. But when things are bad, let's say the opposing stock that you found was the stock of a bankruptcy law firm. All they do is bankruptcies. Well, when the market's doing well and the bank stock's going up, the bankruptcy guys have nothing to do. But when the market crashes, they've got a lot of bankruptcy cases. This would be 2 opposing movements, basically, and the correlation between these 2 would be such that it would be a negative correlation, and it would add value to reducing risk of the overall portfolio. But it is not likely that you're going to find it. Now, some stocks have very low betas. In theory, when investing in a high beta stock, an investor generally should demand a higher return. So what beta do you use? Let me ask you that question. How do you get it? Let's look at that in more detail. What's your choice of the time period? 1 year, calculated over 3 years, 5 years, 10 years, beta over a whole cycle? What would you use? What's your choice of frequency? Beta is the calculation of the change. It's using the change in the stock relative to the change in the market. So are you looking at percent change on a daily, a weekly, a monthly returns? What are you looking at? What's the correlation? Those are 2 decisions you have to make, time period and frequency of returns. And I'm just going to tell you right now, the secret's out. There is no right answer. They're all wrong, and they could be right. Let's look at that in a little bit more detail. I've taken an example of a company, Bumrungrad Hospital here in Thailand, where I'm recording this video right now. And it's an example of how flimsy beta can be. Now, a monthly return beta varied widely. If I look at it, if you look at 2008, the beta was 0.9. Market risk. Whoa. 2009, 1.5. Then all of a sudden it becomes 0.4, then 0.3, then negative. Then it bounces back to 0.7. So depending on whether you're looking at a 1 year, 3 year, 5 year beta, you're going to get very, very different results. Now, let's look at how flimsy the beta can be in another direction. Let's just look at 1 year. In 2009, beta of different frequencies varied massively. What am I saying? Well, if you had calculated the 2009 beta based upon daily returns, you would have got 0.5. Weekly, 0.6. Monthly, 1.5. The range is massive. About 1 is the range. So that can show very, very different range. Now, you could say, well, I'm just going to use Bloomberg's beta because that's what everybody else is using. Yeah, possible. but very possible it could be the wrong one. So a common mistake is valuing a stock using the calculated beta, using a too high or too low beta, just using whatever historical beta you find in something like Bloomberg or your data provider. And here's where it gets funny. Calculating your own beta could be a mistake. Failing to realize that valuation is made to infinity. Hence, your beta is a forecasted beta, and that forecast is to infinity. I saw an academic paper that showed that the success of beta selection was better if you just choose one than what analysts were choosing. I can't find that research, so if you ever could find that research, please send me a message. So, what beta should I use? That's a question you're probably asking me now. I've just blown up a lot of things that you shouldn't do. So let's look at some academic style research I did about our high or low beta sustain. Remember that academic research style that we use is this format. You ask a question, you review the prior research, you look at and formulate a hypothesis, you gather your data, you look at your methodology of how you're going to calculate it, you look at the results that it produces, and then from my perspective, I care most about what action it can lead me to. So let's look at this. I'm going to skip some of those items and just go straight to the question. Does high risk mean high return? And when I say high risk, I'm saying high beta. What happens to beta over time? Are high betas or low betas sustained? So if an analyst was to value a company by looking at the beta in Bloomberg and the beta was 2, should we use 2? Should we use 1? Should we use 0.5? What do we use? So the hypothesis is that beta changes over time and reverts to 1. Now, here's the data. 10,000 stocks listed at any point in time on any stock exchange in the world from 1995 to 2015. We basically can look at a lot more stocks in this study because we don't need fundamental data. We just need price data. So consider the top 3 deciles with the highest beta. So we'll call those high beta, and the bottom 3 deciles with the lowest beta. We investigated what happened to the average beta of these stocks over 10 years. So here's the result. High beta stocks come down to about 1.1, while low beta stocks stay at about 0.7. Interesting. What we can also see is that the lines converge pretty quickly. So within a year or so, the beta could be dramatically different, from 1.42 down to 1.2, or from 0.33 up to almost 0.6. So that even just tells us right there that whatever beta you're calculating today is not the beta you should be using. So what do you do? How to avoid this mistake? Do not plug in the current beta and think you got it right. Keep your betas within a range to prevent mistakes of these extremes. A safe range is 0.75 to 1.5. When I was a head of research, I also saw that analysts like to manipulate beta to get the result that they wanted as far as the valuation is concerned. But really, the market return, the risk-free rate, and the beta selection for each country should be set pretty much by a head of research or a methodology. And the benefit of putting a tight range on beta is that you prevent the analyst from coming up with extreme valuations, and you prevent yourself from coming up with extreme valuations that are probably errors. It doesn't mean that you can't go outside of that range, but you've got to be able to prove that you've got good thinking on why you're outside that range. So what have you learned? Past betas tend to regress towards 1, but not to exactly 1, at least not in 10 years. But what about to infinity? That's a good question. The beta you use for valuation is to infinity. To avoid error, we use 3 betas that I use. I say, look, if it's high risk, use 1.25. If it's average risk, use 1. If it's low risk, use 0.75. You say, but Andrew, why should I use 1.25? The beta of the stock is 2. Well, go back to the bullet number 2, and that is that you're forecasting beta to infinity. That's 50 years. That's long, long time that matters in an infinity forecast. So the last thing is, if you use a beta outside of this range, you have a higher obligation, in my opinion, to justify that beta. So that's what you've learned in this section. Next, coming up is choosing an unreasonable cost of equity, and I'll see you there.